Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. This video presents a direct informational narration of the source document. So here's a quick look at what we'll be covering. We're going to start with the initial risk disclosure and get a feel for the current market sentiment. Then we'll dive into some company-specific assessments, looking at NVIDIA, Amazon, and Lululemon. We'll wrap things up with a look at some IPO prospects and a final summary, followed by the professional risk disclosure. This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk, including the potential loss of principal. All strategies, market views, and analytical content are presented for reference only. Right now, the U.S. equity market is really in what you'd call a classic low-conviction holding pattern. What does that mean? Well, it's marked by super low volatility and trading that's just stuck in a narrow range. With everything going on geopolitically still up in the air, the market is basically just waiting for some kind of catalyst, something big enough to push past the current valuation ceiling. And we're seeing institutional investors start to pull back and get more defensive, which is putting a cap on any near-term upside. Now, some hard data from Bank of America's March Global Fund Manager Survey really backs this up. And this is a pretty significant sample size, It covers 210 managers who are collectively overseeing a massive $589.1 billion in assets. And what it shows is a really notable shift in how they're managing liquidity. And here's the key number from that survey. The cash allocation ratio shot up to 4.3%. Now, the context here is absolutely crucial. This jump from the January low, it's the largest single-month increase we've seen since the big pandemic shock back in March of 2020. So yeah, it is a significant move. So what does this actually tell us? Well, this rapid shift back into cash shows that professional investors have really hit the brakes on the aggressive risk-taking we saw at the start of the year. The rotation out of stocks and bonds and back into the safety of cash, it strongly suggests the market is starting to question if the potential rewards are really worth the risks at these current price levels. And speaking of risk, let's look at rate expectations. The market is pricing in a 98.9% probability, so almost a certainty, that the Federal Reserve is going to hold rates steady at its next meeting. But while rates are expected to stay high for now, the market seems to have settled on the idea that a rate-cutting cycle will finally begin in 2026, with about a 70% chance of a 25 basis point cut. Okay, let's move on to our first company-specific analysis, and we're starting with NVIDIA. The whole narrative around this stock is shifting. It's moving away from just being a concept-driven story to a valuation that's really driven by hard financial numbers. So, management has set a massive target. $100 billion in cumulative revenue over just 3 fiscal years. To get there, here's the path they need to take. For calendar 2025, the consensus is $21.59 billion, which sets a really high base. For 2026, the market expects that to jump to $36.80 billion. And then, to hit that cumulative target, the implied value for calendar 2027 has to be about $41.61 billion. If they pull this off, it would be a truly historic milestone for the entire semiconductor industry. Now, as NVIDIA's revenue base starts getting close to $40 billion a quarter, it's just financially inevitable that its growth rate will start to normalize. It'll probably settle in around 30% in calendar 2027. But this isn't a sign of weakness at all. Instead, it's the natural transition you see when a company moves from an absolutely explosive growth phase into a more mature one. This brings us to the company's financial strength. To address any concerns about spending, NVIDIA's CFO has come out and said that 50% of their cash flow is going to be allocated to shareholder returns. Think buybacks and dividends. This is a really smart, forward-looking move. It validates the incredible cash-generating power of their AI business, and strategically, it provides a much firmer floor for the stock's valuation multiple. So if we try to quantify that valuation and look forward to fiscal 2027, applying a forward price-to-earnings multiple of 30 to 40 times gives you an implied target price range of between $234 and $312. And if we look even further out to fiscal 2028, using a more conservative PE framework, say 20 to 30 times, the implied forward price range is between $197 and $295, with a midpoint right around $246. The real key takeaway here is that the stock's recent consolidation, it's seen as the fundamentals finally aligning with the price, not some bubble that's detaching from reality. Next up, let's turn to Amazon. The CEO recently gave a revised 10-year forward view for its cloud division, AWS, and it sent a major signal about the future of the entire market. And this is a seriously significant revision. The 2036 revenue target for AWS was doubled. They revised it upward from $300 billion all the way to $600 billion. This kind of revision just signals massive confidence in the expansion of the cloud's total addressable market, and you can bet that's being driven by AI. The impact here goes way beyond just Amazon. When the market leader projects a doubling of infrastructure demand, it has what you call a meaningful read-across effect for its peers. It implies that Microsoft Azure and Google Cloud should also be able to capture a piece of this exploding market. And the source notes that this long-term fundamental positive hasn't really been fully priced into Amazon's stock yet, which could be creating a positioning window for capital with a longer-term view. All right, now for a bit of a contrasting story. While the big tech giants are showing a lot of resilience, Lululemon is actually facing a dual challenge, a slowdown in its forward guidance and some serious friction with its corporate governance. If you look at the numbers, the issue becomes pretty clear. While their historical fourth quarter performance was actually solid, earnings per share came in at $5.01, beating expectations, the forward guidance shows what the source calls a cliff-like deterioration. Their Q1 EPS guidance of 1.63 to 1.68 came in dramatically below the 2.07 the market was hoping for. And compounding this growth problem is a full-blown governance crisis. There's a very public split between the company's founder, Chip Wilson, who still has a 9% ownership stake, and the board. He's been criticizing them for lacking strategic foresight and for failing to maintain leadership stability, pointing to 3 different CEO departures. This internal friction is just eating up corporate energy at a really critical time. Okay, in our final analytical section, we're going to touch on the prospects for some major technology IPOs, and then bring it all together with the key conclusions from this market analysis. So there's been a ton of talk about potential IPOs from huge companies like SpaceX and OpenAI. But from a purely capital markets mechanics perspective, the source indicates this is all still a very early conceptual stage. A successful large-scale IPO really depends heavily on the market's financing window, and if the S&P 500 stays in this consolidation pattern, major IPOs typically get postponed until both enthusiasm and liquidity are high again. So to wrap things up, the big takeaway is that the U.S. equity market is in a major transition. It's shifting away from emotion-driven trading to a framework that's much more focused on earnings and forward guidance. In this kind of environment where investors have sharply increased their cash holdings, assets with strong cash return capacity like NVIDIA or clear visibility into an expanding market like Amazon are expected to show much greater resilience. Meanwhile, brands like Lululemon, which are constrained by governance issues and slowing growth, are going to have to confront the reality of a valuation reset. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, trading advice, or any recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor. Any investment or trading decision made based on this document is undertaken solely at the reader's own discretion and risk. Past performance and historical analysis are not indicative of future results.